What is this? Why am I taking this candle? Liquidity sweep. Oh my god. Demand. I have no clue what any of this is. Hello, my name is Derek Bathgate and I have been trading for around 3 to 4 years now. And in this video, I'm going to go back to the very first playbook I ever made and go over my old trades. And to be honest, 90% of the trades I go over, I have absolutely no clue what I was thinking. Most of them don't even make sense. At least you get to see the progress from where I started to where I am now and what things I have changed in the process. So if you've ever felt lost in your trading and you don't feel like there's an end game, you're a bit stuck, this video is for you. So here we are on my very first trading plan. If we jump over to the trading plan side, we have our daily /H4 to where I was marking up my identifying the direction, identify the price range. How do you identify the direction? Because it doesn't explain how. So if it doesn't explain how, you're going to be guessing. That was one of the biggest things that I changed within my trading, that I don't have anything that lets me guess anymore. It's a set mechanical trading plan that I have now, that I don't have to guess what direction price is going. I don't look at a chart and maybe that was a sweep of liquidity, maybe that was some displacement. So we've got premium and discount, which that is actually really quite similar to my IRL to ERL and ERL to IRL. So if you think about it, premium is the most expensive part that you shouldn't really be buying or selling within, and then discount is where you should be buying and selling. IRL to ERL, we have our internal range liquidity, anything within a current leg. We have the ERL expansion, pull back to IRL. IRL would be your discount, ERL would be your premium to where you don't trade. So it's the exact same theory, just named different. Identify pro trend or counter trend for the H4. How am I supposed to identify when it doesn't tell me exactly how to identify it, which is kind of stupid back then, but I suppose it's all a learning phase at this point anyway. Higher time frame, structure, premium and discount, liquidity, inducement. Sure, I used that an awful lot. A lot of these things that you learn over time turns out to actually be nonsense until you filter it out. Then you realize how nonsense the thing actually is. POI mitigation, supply and demand flip. So that would be once price break structure gives you a change of character, you drag your demand or supply over and price should come back up to this area, which I do not trade a supply and demand flip. I do not even trade supply and demand fair value gaps for that matter. Lower time frame, mitigation, liquidity, inducement, chalk, flip, discount. So much to try to remember to enter a trade on the lower time frame. It should really just be liquidity sweep break, enter. How you enter, a limit order or a market. It shouldn't be multiple 10 different things that you need to take into consideration before you actually enter a trade. So that's when you just overanalyze trades. Risk management, we have a 0.5 to 1% per trade, which is still great. That is great risk management. Even back then when I first started, maximum 2 losses a day. I would only take 1 loss per day now, as 2 losses would really fuck up your psychology rather than just 1 a day. 25% partials at 1 to 3, and that is quite mad because 1 to 3, I am really quite happy with a 1 to 3. It's not too high and it's not too low. So I was parceling at this point at 25%, meaning I must have been targeting an average 1 to 10, which is incredible. And that's another thing, when you first start off, you think a 1 to 2, a 1 to 3 is bad, or you need to be targeting a 1 to 10. If you have £500, you'll be earning £5,000 per trade, which is a stupid way of thinking. You should really be targeting low but consistent, because if you're waiting for these 10% returns, 20% returns, you'll be sitting on your hands and you'll be losing a lot more trades than you hope, because the expansion and pip range needs to be a lot higher than your average 1 to 2, 1 to 3. To be honest, I'm not taking massive percent, like I'm not targeting 10%, which is crazy. This must have been a bit later to when I started trading. So we've got liquidity, floor, first level of respect, break of structure, chain, extreme. Stop loss size, quite similar to what I've got right now, to be honest, which is nice to see. We have a break of structure, expansion higher, pull back into this leg, which I was probably looking at this as the last demand that expanded higher and took out the break, which sort of correct, but for me now, it would probably be this candle, as that slightly swept liquidity there, sell side liquidity. That would be my demand if I was marking out my POIs. Price should have came back down and then expanded higher, but I have taken the most recent demand that expanded higher. Still, it makes sense to think that that would be the low as it caused the expansion, but it's not always the case. That's just an internal sort of liquidity pool where the low is actually the one that first swept liquidity before the break of structure. It looks like price has mitigated that sort of demand where we have swept liquidity have our chain demand. I'm not too sure. I don't really know what the fuck this is, to be honest. So what time even would this be? This came down, I entered around 5 p.m. So that's near enough, what is that, New York close? We have some sort of inverted demand. I have no clue what any of this is. And I entered on this sort of extreme. Couldn't tell you. I don't know what the fuck this trade is. If we go into another one though, what is this? This is a short. See what I mean? Like, there is clearly no statistical edge to this. There is no reason to why this, what even is this, you know? It's a supply, some sort of, I don't even know, because if you look, I don't even mark anything. I mark this sort of supply here. Why would that hold out of any supplies that's already been mitigated? It's just stupid. So we have broke that, pulled back. I wouldn't be trading anything like this now. That's kind of embarrassing, because what the fuck even is that? Alright, so we go over to the trade. See what I mean? Like, what even is this? This is actually grossing me out. We have a buy-side liquidity sweep of whatever sort of liquidity this is. Mitigate, a sweep of liquidity. And where am I entering? There is no even break of structure. There is no pullback. That's a fucking liquidity sweep. We've pulled back. Oh man, what is this? What is this? Why am I taking this candle? Liquidity sweep. I am, oh my god. What's this? A wick. I am taking the wick is the extreme break of structure pullback. And I limit order solely on the mitigation of this wick, which doesn't even make any sense. There is no confirmation to why this trade would actually hold. This sounds promising. What the fuck? Let's go on to my current trades and you'll see the transformation from then till now and how I actually trade. Here we have Euro USD for a 2.6% return. We now have a massive explanation to why I entered the trade, which every trader needs to do this in their playbook. We have Euro USD reversal buy, stop loss 5.6. All of this stuff that I am putting down here is the exact same management rules, the exact same times that I enter, news, profit, how much I profited. You know, it's the exact same stuff that you'll see all of the time. And all of this helps you refine your playbook, which massive thing that changed my trading. As stop loss size, you can determine what your average stop loss size is over multiple trades. Time of execution, massive. This helps you not stay on the market for hours every single day. This allows you to solely enter at specific times to when your trades work out, when they don't work out, when they're faster hitting TP. You know, it's just great having all these sort of little things that you can refine and add to your current playbook. So if we get into the trade side, we are bullish, break structure, liquidity sweep, internal liquidity sweep. Our next liquidity target is the next high. Makes sense, because that is set IRL to ERL, ERL to IRL. External range liquidity, anything after a break of structure. Internal, anything when you pull back within the current leg that price was already playing within. And then external again. So it's practically your premium versus discount. So after the break of structure, that would be your premium. You do not enter. Discount would be anything within the leg. Here we have our initial break of structure. After we have a break of structure within our current leg and change character, our next liquidity target would be the next again high following expectational order flow. So that would be your ERL if we are bullish. If you're bullish, you would be eyeing up the next again high. Here we have a reversal model where we expand lower during London, sweep liquidity and break structure. As soon as we break structure, we enter and solely target opposite side of Asia. If we go into the more refined, you'll see a lot clearer. Sweep of liquidity, London open lower, gives us a reversal model. Break of structure, solely entered on the break of structure and targeted there. So that was a nice 2.6. Here we have a trade on the 9th of October for a 2%. Here we have our H4. Liquidity sweep, break of structure, makes sense. Now we would be looking for an IRL return, but we're clearly taking the expansion from IRL, so we have mitigated. Our current leg would be this one here. This is the high. All the way down, this one isn't a leg because it didn't sweep, it just broke. So that would still be considered as our current leg. All the way down here, price has pulled back, swept buy side liquidity. Here we have the buy side liquidity sweep. Break of structure, liquidity sweep here as well. Price has pulled back to the 50% level and continued lower. So these are the sort of textbook trades that you want to look for, as they have exact easy confluences you need to look out for to get into your trades. I hope you enjoyed this video. It is a bit different to my last ones, as the last ones are mainly trade breakdowns, teaching you how to identify internal versus external. But anyways, I will catch you in the next one.